Ogadima Limited retails two products, common and executive traveling bags. The budgeted income for the year 2015 is as follows. All information is considered to be accurate. Required, calculate the break-even point, the break-even units, assuming that the planned revenue mix is maintained. B, determine the break-even points in units if only common bags are sold and if only the executive bags are sold. C, calculate the budgeted operating profit and break-even point if 200,000 units are sold, but only 20,000 units are executive bags, 15 marks in total. So this is the question. Of course, this question relates to break-even analysis, but for the fact that this company, Ogadima Limited, produces two products, common as well as executive bags, then this means this is a multi-product break-even. So if it's a multi-product break-even, I gave you about 5 procedures you are expected to carry out. However, those procedures will depend on the requirement of the question. In the A part of the question, you are to calculate break-even points in units, assuming that the planned revenue mix is maintained. So in this case, we are going to carry out the entire 5 steps. The first step is to compute the overall contribution margin ratio. Because of time, let me switch to the working note so that just solve it straight. All right. Solution. So illustration 7. That's page. What page is that? That's page 67. Page 67. So the name of the company is Ogadima Limited. Okay. So examiner is asking you to calculate break-even points in units, assuming that the planned revenue mix is maintained. So number A, calculating break-even points in units. So like I explained to you in our last class, there is no way you can compute directly break-even points in units without carrying for multi-product organization, without carrying out those procedures. So the first thing you are going to do is to calculate the overall contribution margin ratio. So to do this, just say contribution margin ratio for the company as a whole. Of course, contribution margin ratio is fixed cost divided by, sorry, what am I saying? Contribution margin ratio is contribution divided by sales. I can see Oliver is back. Okay.
Good evening, sir.
Good evening. So let's go back to the question. Then, of course, contribution margin ratio is contribution divided by sales. According to the question from the table given to you, contribution margin is 30 million naira. Sales value is 90 million. Therefore, 30 million divided by 90. 30 million divided by 90 million. This is the same thing as 1/3. And then 1/3 is equal to 0.123456789. Okay, please, when you are doing this, don't do rounding. You don't round your figure until you get to the last number. You can only round the final number, not in this case. Because once you round it, your final answer will not be correct, will not be appropriate. You may be doing the right thing, but because you have rounded your number, you won't get the accurate number. Then step 2 now. Step 2 says you should calculate the overall break-even point in naira. Okay, that is break-even point for the company as a whole. Therefore, break-even point in naira will be equal to fixed cost divided by contribution margin ratio. The fixed cost for the company is how much? According to the question, it's 12 million naira. So here will be 12 million divided by the overall contribution margin ratio, which is 0.3456789. So what do you have? This will give you 36 million naira. Okay, so that's the break-even point in naira for the company as a whole. Then step 3 says you should calculate sales mix for each product by dividing the revenue of each product with the total revenue. So we calculate sales mix. So we have common. We also have executive bags. The revenue of common is 60 million. Okay, let me first thing first. Yes. Revenue of common is 60 million divided by the total revenue. Total revenue is 90 million. Therefore, this will give you 6/9. 6/9 is the same thing as 2/3, but you don't have time to be doing all of that. Just say 0.66665667, then 7. That will be 9. Then again for executive, revenue for executive is 30 million. The total revenue for the company as a whole is 90 million. So this is 3 divided by 9. Of course, it's the same thing as 1/3. So this will be 0.123456789. So 0.3333. All right, when you add up, it must be equal to 1. So this is the 6 means. Then number 4. Step 4 and 5, we are going to marry them together. Step 4 says you should calculate break-even point in naira for each product. And then step 5 says calculate break-even point in units. So I would then say break-even point in naira and units. Okay. You use one table to kill the two. Yes, the first item will be the product, followed by sales mix, then followed by break-even points in naira for each product, selling price, then break-even point in units. So we have 2 products, common, then executive. Sales mix of common is 0.62345678, then 9. Then sales mix of executive is 0.33345678, 9. So when you add it up, it's equal to 1. This one is 1. Then break-even point in naira. We have computed break-even point in naira for the company as a whole to be 36 million naira. So this guy will be 36 million. Let me complete my table. Yes, what's the selling price of common?
Selling price is 200.
300 for common. The executive is what?
Common is 200. Executive is 300.
Okay. Now, to get the break-even points in naira for each product, you are expected to multiply the sales mix of each product with the overall break-even points in naira. Therefore, 0.6667 multiplied by 36 million. What you get?
I think you get 24,000.
24 million. Then
24 million rather.
to get the break-even point in naira, you divide the 24 million naira with selling
By
price.
200.
So
By
that will
200.
give, yes, that will give you the break-even point in units.
1,200. 120 units. 120,000
120,000.
units.
Okay, so do the other one for executive. 0.333 multiplied by 36 million should give you 12 million.
12 million, then 40,000 units.
So divided by 300 will give you 40,000 units. So we are done. 3 marks, you pocket it. This is how to calculate multi-product break-even points in units as well as in naira. Then the B part of the question, you have to determine the break-even points in units if only common bags are sold and if only executive bags are sold. Now, what the examiner is telling you is that you need to calculate it independently. What if the company produces only a common bag? What is the break-even point? If the company produces only executive bags, what's the break-even point in units? So that's what the examiner is asking you in this. Then number B1, B Roman figure 1, break-even points in units. In units, if only common bags are sold. So if only common bags are sold, then break-even point in units is calculated as fixed cost divided by contribution per unit. And fixed cost is 12 million naira. Then contribution per unit for comma. Of course, selling price of comma is 300. Variable cost of common, is 200. Variable cost of common is 160. We did it in our last class. So the difference is 16 naira. So here will be 16 naira. Let me write that is 200 minus 140 naira. So what do you have there? 12 million divided by 60.
That's 200,000 units.
200,000 units. So if only executive bags are sold, the break-even point in unit would be 200,000. Then high, B high. Break-even point in units if only executive bags are sold. So in this case, the break-even points in units will be computed as fixed cost of 12 million naira divided by contribution per unit of executive bag. Contribution, selling price of executive bag is 300. Variable cost is 180. So that's 120. 12 million divided by 120 naira will give you what? That should be 100,000. Am I correct?
100,000. Yes.
So that's it. Again, once you are done with it, just pocket it. That's what the examiner wants you to do. Don't need to waste time on this. That's 6 marks. You pocket it. Then number C, calculate the break-even, the budgeted operating profits and break-even points if 200,000 units are sold, but only 20,000 are executive bags. 3 things you are going to do in this instance. First thing first, you need to calculate a revised budgeted profit. The current operating profit is 18 million naira. Now, examiner now told you that the company will produce 200,000 units. Out of these 200,000 units, 20,000 is for executive. If 20,000 units is for executive, it means that the balance of 180 is for comma. Therefore, you need to prepare the revised operating profits. After that, of course, you recalculate your overall contribution margin, then you recompute the break-even points in units. So number C, Roman figure 1, budgeted profits. Revised budgeted profits. Revised budgeted profits. So we have common, executive, then the total for the company as a whole. 20,000 is for common, 180 is for, 20,000 is for executive, 180 is for common. That's how we share the 200,000 units. Okay, so says selling price of common is 200. 200 multiplied by 180, that will give you 36 million. Selling price of executive is 300. 300 multiplied by 20,000 will give you 6 million.
6 million. Yeah.
When you add it up, that will be 42 million for the company as a whole.
Yeah.
Then you less variable cost. Variable cost of common is 140.
yeah.
140 multiplied by 180.
You get 200,000.
That's 25,200 minus 36 million. We give you 10,800. That 10,800 is the contribution margin. Then the variable cost of executive is 180. 180 multiplied by 20,000.
Give you 3.6 million. 3,600,000.
When you less from 6 million, that will be 2.4.
Yeah.
Okay. So when you add the two, 25,200,000 plus 3.6 million, that's 28,800. 28,800,000. When you minus the difference, this will give you 13,200,000. That's the revised contribution margin. Then to get the revised budgeted profit, you less fixed cost. According to the question, fixed cost is 12 million naira. So 12 million minus 13,200 will give us 1.2 million. So that's the revised budgeted profits that examiner wants us to calculate. Now, that's one. Number two, C2, revised contribution margin ratio. Since our contribution margin has changed, our sales value has also changed. Therefore, the revised contribution margin ratio for the company as a whole would then be equal to 13,200,000 divided by the revised sales of 42 million. So what do you have there?
0.3143.
3142. Everything as don't round. You don't round it. I've already said it. 3142.
Sorry,
let me do it. 13,200.
So 3142,85714.
3142.
85714.
7143. 1, 2, 3, 4. Okay.
3142,857.
857. 143. Let me see, so that we'll be picking the right answer. 13,200. 13,200 divided by 42,000. So 3142,874, 7143. So that one is correct. Then So that is for that. Then the next thing we are going to do, we need to calculate the break-even point. Number 3, break-even points in units. So to do this, we start from the first step. Of course, the first step, the one you have, the revised contribution margin ratio has taken the first step. So we need to calculate break-even point first. Break-even point in Naira. So which, of course, you know is fixed cost divided by contribution margin ratio. And the fixed cost is 12 million Naira. The contribution margin ratio is 0.3142, 4285, 7143. So what do you have there? That will give you 38 million what? 38 million 181,818. Am I correct? Please confirm.
Yeah.
Okay.
38 million.
So that's the overall break-even point in Naira. Now that you have the overall break-even point in Naira, of course, we need to calculate the sales mix. Sales mix for common, then for executive. Sales mix for common. The sales value of common is 36 million divided by total sales. 36 million divided by total sales of 42 million. So this will give you what? That's 6/7.
Yeah,
right?
0.8,
which is 0. What?
0.85714
85714
2857.
2857. Is it up to 9? 1, 2, 3, 4. Yeah. Okay. Then the second one, executive. So this is 6 million divided by 42 million equal to 1/7.
1/7.
So which is will be equal to
0.1428
what? 1428
142857142.
143. It must be equal to 1. Whatever you are doing must be equal to 1. Let me try here and say 6/7. 6 divided by 7 equal 8571428571. Hold on. Must be equal to 9. 1, 2, 3, 4. 1, 2, 3, 4. 7. Okay. Then the other one is 1 divided by 7 equal 142857143. Yeah, that's correct. So your answer must be equal to 1 at the end of the day. When you add it up, it must be equal to 1. Then after sales means, we need to calculate the break-even point in Naira and units. Okay. So for, of course, create a column for the products, sales mix, then break-even points in Naira, selling price, break-even points in units. Common, executive. Here is 0.857142,857. Here is 0.1428 57143. So when you add it up, must be equal to 1. So here is 1. Then you want to share. You want to share the break-even point, the overall break-even point in Naira. Selling price for common is 200. Executive is 300. You want to share 38,181,818 Naira. That's what you want to share. This is what you are sharing. All right. Therefore, multiply the sales mix of common with 38,181. What you get? Yes. What you get?
For executive,
Uh-huh.
5 million
I'm coming.
454.
818. You say 5 million
Yes,
for executive.
454.
Oh, I just
No,
did the executive. I was expecting you to do 5
executive.
million,
Okay,
5,
million
4, 5, 4,
545.
5, 4, 5. Then here will be 32. 32 what? You know, you need to divide your answer by the selling price to get the sales units. So here will be
Okay.
divided by 300. That's 181 units. Okay. Yes, what do you have for common?
So hold on, I'm coming to 28,
This will be
1,
182.
8, 8, 1, 8. Okay. 32, 727, 270,
727, then 270, right?
270. Yeah, that's what I
Divided by
got.
200. Divided by 200. It's not correct. Your answer is not correct. It should be equal to, it should balance. When you add the two together, it's not equal to 38,181,818. So it should be 0.85, 0.857142, 857, 857 multiplied by 38,181,818. That should give you
Okay, sorry.
32,
It is
727, 272
272, yeah.
plus 1. You know, we have
272,
0.5, so
273. Yeah,
that should be
273.
273.
Mm.
So you divide that by
Divided by
200
200.
units.
You get 163, 6,
Okay?
36,
163, 636.
636.
163, 636 units. That's it. That's the end of the question. 15 marks. You pocket it. All right. This question should not take you more than 15 minutes to solve. And you're looking for, once you pocket these 15 minutes, go and look for 85 marks. Sorry, 15
Hello, sir.
marks.
Hello, sir. Hello, sir.
Yes.
The break-even point in Naira for the executive, 5 million for what? Is it 454?
Is 54.
5,454,000.
Okay, okay, sir.
So let's go to the last illustration. Let me stop sharing this. So Abayomi is the last question we are going to solve on CVP. So I need somebody to read.
Babayomi's illustration 7 on page 67. I read.
Thank you.
Babayomi PLC produces and sells two major products, A and B. The budgeted income statement for the year to December 31st, 2022 is given below. the information assumed to be correct. The budgeted selling prices of the product are A, 120, B, 180. Required. A, determine the break-even sales in units for each of the products using the budgeted data. Now assume that the following changes are made to the budget. 1. Unit selling price of product B is reduced to 160. 2. Direct material cost is expected to drop by 10% for product A and 20% for product B. Direct labor cost for each product will increase by 10%. Additional 456,000 will be spent on advertising. 80% of the total revenue will be derived from product B. B. Calculates how much sales revenue must be made to earn an after-tax rate of return of 12% of the revenue. Assume tax rate of 40%. C. Assume all the facts in B above from I to V above, but with the original budgeted revenue of 33,600,000. Compute the reverse break-even sale in units for each of the products.
Thank you very much. Yes, that is the question. The first requirement says you should determine the break-even points in break-even sales in unit for each of the products using the budgeted data. So in this case, of course, just follow the normal procedure for calculating break-even point for multi-product organization. Let me stop sharing this. I'll move to the working notes. Okay. Solution. So illustration 7. Still on page 67. The name of the company is Abayomi PLC. So examiner is asking you to determine break-even sales in units. So number A, requirements, calculating break-even points in units. Of course, you are expected to follow the 5 procedures. The first procedure says you should calculate overall contribution margin ratio, which is contribution, the overall contribution divided by overall sales. When you go back to the question, according to the question, the contribution is not given to us, but you have to calculate contribution by yourself. All right. The overall sales value is 33,600,000, but we don't have contribution. So let's calculate contribution. So you now said contribution. How do you compute your contribution based on the information available? I can calculate contribution in 3 different ways based on the information given to us in this question. So I have product A, product B, then total for the company as a whole. The sales, I don't want to follow this step. You know, contribution is profit plus fixed cost. So contribution is profits plus fixed cost. That's what you should do. This one will be faster. So I will then go back to the question, what's the profit for A? The profit of A is 3360. 3360. 3360. Profit of B is 12,880. 12,880. All right. Then fixed cost. according to the question, fixed costs. In fact, since I'm doing for the company as a whole, the contribution I'm looking for is for the company as a whole. I don't need to be wasting my time and be doing it one by one. So in
Yeah,
this
just pick
case,
the total.
just pick the total. That's what I need to do. I don't need this. I don't need this. So in this case, I will just pick the fixed cost, the profits, the overall profits, according to the question, is
You have 16
240.
240.
240, yeah.
16,240. 16,240. Then fixed cost. All right, fixed cost. There are two elements of fixed cost. We have fixed overhead of 2,240. We also have fixed selling and admin expenses of 8,320. 2,240. Okay. Let me come here. Fixed cost equal to 2,240 plus 8,320. That will give us 10. What? 10,560. All right. So here is 10,560. When you add it up, what do you have there? You record that, hold on, you record, you are not using, the net profit is 7,920, not 16,240. This one is 7,940. 4, no, what did I say? What did I pick? 7,920, yes. That's your net profits. 7,920. Add it up, what do you get? Yes?
18,480.
18,480,000. That represents the overall contribution margin. So the overall contribution margin is 18,480,000. So I can then come here. Contribution margin is 8,480. Figures are in thousand. Divided by the overall sales, which is 33,600. Right? So what do you have here? 0. What? 18,480 divided by 33,600. That's 0.55 or 55%. So the overall contribution margin ratio is 55%. Then step 2. Step 2 says we should calculate overall break-even point in Naira. Break-even points in Naira for the company as a whole, which is fixed costs divided by overall contribution margin ratio, which is equal to the fixed cost is 10,560 divided by 0.55. So this will give us 19,200. Then step 3 says we should calculate sales mix. To get the sales mix for A and B, I will then go back to the question. The sales value of A is 8,400 divided by 33,600. 8,400 divided by 33,600. What do we have there? Then here is 25.
0.25. 0.75.
Divided by 33. 600. What do you say is the sales mix?
0.25 for A.
0.25, then 0.75. All right. So that's the sales mix. Then step 4 and 5. Match them together. Break-even points in naira and units. So products A, B, then sales mix 0.25, 0.75. Break-even points in naira. We have gotten, you have to write it out in full. Here is 19,200,000 so that you don't make mistake. Whenever you want to determine your break-even points, okay, in units. So write it out in full so that will avoid you making a mistake. Then break-even point, sorry, selling price. All right. Now, what's the selling price of A? According to the question, the selling price is 120 and 180. 120, 180. Therefore, 0.25 multiplied by 19.2 million.
4,800.
1,800.
4,800. 4.
Divided by 120. Divided by 120.
40.
40,000 units. The next one, 0.75 of 19.2 million. That was 14 million.
14,400.
400,000. Divided by 180.
80.
80,000 units. We have answered the first. We have answered the first requirement. All right. We have answered the first requirement. Okay. 6 marks. You pocket it. The next one, you are asked to calculate how much sales revenue must be made to earn an after-tax rate of return of 12% of the revenue. Assume tax rate to be 40%, 5 marks. This particular requirement is very technical. You have to be very careful. We have similar question on the day of the exam. Remember, there are changes to some of the variables. Examiner told you that unit selling price of product B is now 160 naira. Direct material cost is expected to drop by 10% for A and then 20% for B. Then, the next, you are also told that labor costs for each product will increase by 10%. So first thing first, you need to make relevant adjustments. If all these adjustments are made, then it means that your contribution margin ratio will also change. But that is not the issue. The bottom line is that now, in this particular question, 2 things happen. After all the changes has taken place, examiner now told you that 80% of the total revenue belongs to product B. So if 80% is for product B, it means 20% is for product A. Now, where you are given the proportion or the weight of a particular product under CVP, and you want to calculate contribution margin or contribution margin ratio, in that case, you are going to compute composite contribution margin ratio. Now, in this particular requirement B, you want to determine the sales value that will enable the company to earn after-tax rate of return of 12%. That sales value, you don't know it. That's what you want to calculate. So that will make the company to earn 12% on sales after tax. So since you don't know the sales value, you are going to use the known variable to get the unknown variable. So first thing first, you need to go and do your workings. All right. So let's go and do workings. For us to achieve that, you need to make a revised, okay? You calculate revised direct material. Your material cost will change. Okay? The material cost for A, let's do it this way. Let me do it this way. Direct cost for A and then for B. If you like, you can do for total. Now, the first item will be material. For product A, what is the current material cost? The current material cost of product A is 2240. 2240, and you are now told that material cost will drop by 10%. So if the material fall by 10%, that means you are supposed to account for 90% for A. So 2240, here is 2240 multiplied by 90%. Okay, this will give you, what do you have there? That will be 2240 multiplied by 0.9. Sorry, error. 2240. 16. Here is 2016.
Points.
Then for B, the total material cost of B is 5040. 5040, and we are told that material B will fall by 20%. So 5040, you account for 80%, since it will fall by 20%. So 80% of 5040 is 5040 multiplied by 0.8. That's 4032. Here is 4032. Okay. Then for labor, according to the question, you are told that labor will increase by 10% each. So the current labor cost is 1120, 3360. 1120, here is 1120, here is 3360. We are told that it will increase by 10%. So multiply by 1.10, multiply by 1.10. Give it to me.
A 1232. 1232.
1232.
Yeah.
Then for B.
Then B will be 3696.
3696. So that's that. Then the next one, the next adjustment we need to make. You are also told that additional fees cost of 456,000 will be spent on advertising. All right. In that case, fees cost will also change. So fees cost. The current fees cost is 10,560,000. You recall? Look at.
Yeah.
That's what we have here. 10,560,000. That's the current fees cost. You are now told the additional fees cost of 456,000 will be incurred. Therefore, this will give you
16,000.
16,000. That's it. That's the revised fees cost. Then the next item. Yes, we also need to calculate contribution margin. We need to calculate contribution margin. So revised contribution. Since the variable cost has changed, then contribution will also change. So revised contribution margin for product A and then product B. Now, the contribution you want to calculate here, let's first of all calculate contribution margin first. So here will be what? Based on the information available, we have made changes. Our sales value. Now, the sales value of product A will remain the same. Of course, the sales value of product A will remain the same as 8,400 because selling price of product A is not changing. It's still the same 8,400. So here will be 8,400. But the selling price of product B will change because examiner has told you that the selling price of the sales of product B will change because examiner has told you that the selling price of product B has reduced to 160 naira per unit. Let me confirm that. Yes, it has reduced to 160 naira per unit. So in this case, what are you supposed to do? First thing first, of course, if selling price reduce, all you are supposed to do is to multiply the revised selling price with the sales, with the units sold. But the unit sold is not given in the question. So first thing first, you need to determine the unit sold. Let me create space. Let's say this is the unit. I want to determine unit sold. Currently, for product A and B, to get the unit sold, you are supposed to multiply, you are supposed to divide the sales. Let me do it this way, which is equal to sales divided by selling price. That will give you the unit sold. So for product A, sales of product A is 8,400. Okay, our figures are in million, are in thousand. So let's write it out in full. Selling price of product A is 120. Then here is 25 million. Is it 25,200? Let me confirm. Sales of product B originally.
It's 25,200. Originally
25,200. 25,200. Okay. 25,200 divided by the original selling price of 180. So what do you have there?
140,000 units.
70,000
for A is what?
70,000.
70,000. Then for B?
140,000 units.
140,000 units. So now that you have the sales units, I can then go back and compute the sales for B. Let me just use a sales of product B will then be equal to 140,000 units multiplied by the revised selling price of 160 naira. So what do you have there?
22,400,000 naira.
22,400,000 naira. That's the revised sales of product B. So I can then go back to my contribution. Here is 22,400. Figures are in thousand. 22,400. All right. Then for variable costs, direct material cost has changed. Okay, for product A, 2016. Here is 2016. For product B, 4032. The next item is direct labor. Direct labor has also changed. 1232. And then 3696. But direct expenses did not change. The second part, after direct labor, you're also given another direct labor. It's not direct labor, it's direct expenses. Okay, the typo, supposed to be direct expenses. Therefore, direct expenses is 1120, then 2240. 1120, direct expenses. 1120. Then the other part, the second one for B is 2240. All right, that's all. Let's find the difference. That will give us contribution margin.
4,032. 4032.
32. For B,
will give us 12,432. 12,432.
12,432. That represents the contribution margin for each product. Now, pay attention. In fact, what we want to calculate is contribution margin, is composite contribution margin ratio. Since you have been given, examiner has given to you the proportion of product B to be 80%, it means that proportion of product A is 20%. Therefore, we need, instead of contribution margin, we need composite contribution margin. So we want to calculate composite contribution margin ratio. So if that proportion is not there, all you could have calculated is just contribution margin. But because the examiner has told you that you should calculate that 80% of the total sales revenue is for product B, since you have given the proportion of B, then of course you cannot calculate only contribution margin ratio. It has to be composite contribution margin ratio. What I'm now saying is that if that percentage of project 80% is not there, you should have just calculated contribution margin ratio. So this is composite contribution margin ratio. So to get the composite contribution margin ratio, you need to first of all calculate contribution margin of each product. Let's say this is A, then this is B. Then contribution margin ratio is equal to B divided by A. So what do you have there? 4032 divided by 8400. Yes?
0.48.
0.48 is the contribution margin of product A. Then for B,
B
0.555.
0.555.
0.555.
555. So that's the contribution margin ratio. Then you need to, they will then calculate composite contribution margin ratio. The composite contribution margin ratio is computed. Let me see if I can, this place is too short. Let me see if I can manage it. Let me push this to the back. Composite contribution margin ratio will be computed as contribution margin ratio of product A multiplied by the proportion, the weight of product A on one side, plus the contribution margin ratio of product B multiplied by the proportion of product B. So in this case, contribution margin ratio of A is 0.48. Proportion of product A is 20% because 80% is for B, then 20% will be for A. So A is 0.555 multiplied by 0.80. Final answer, give it to me. I don't have space. Yes. 0. What?
So hold on, please.
Pardon?
The final answer I got is 0.54.
You are correct, 0.54. So the composite contribution margin ratio is 0.54 or 54%. This is working. That's working. All right. Now that you have the composite contribution margin ratio, then we can then proceed to solve the requirements. That requirement number B. In fact, this question should be more than 5 marks. So it's more technical. So you want to determine the sales revenue to earn an after-tax rate of return of 12%. Therefore, number B now. So all these ones are just working to get the B. Number B. Sales revenue to earn profit after tax to earn a rate of return of 12% profits after tax. Okay, that's the requirement. You will recall that whenever you want to calculate break-even points to earn a targeted profit, your formula is, of course,
Fixed cost plus the targeted profit.
Fixed cost plus targeted profit after tax. We are given profit after tax. You need to convert it to profit before tax. Therefore, divided by 1 minus tax rates. All of this divided by contribution margin ratio. This is the formula, isn't it? Now, this is not just contribution margin ratio. It is now composite contribution margin ratio because examiner has given you the proportion of product B. Then you have to calculate composite. Now, the sales value is what the examiner is asking you to calculate. You don't know that sales value. So instead of you to use break-even point in Naira, you call it sales value, sales revenue. Sales revenue is equal to fixed cost and all of that. That's that. Then you then select sales revenue. Let's sales revenue because you don't know it. Your profit after tax, 12% profit after tax is on sales revenue, and that sales revenue you don't know it. So you then select sales revenue equal to X. So then fixed cost. Have a revised fixed cost of 11,016,000, right? That's our revised fixed cost. 11,016,000. This is it. Then, from this same formula, the targeted profit after tax is 12% of sales revenue, and the sales revenue is already X. Therefore, this will be equal to 0.12 of X. Then also, the tax rates, T, which is the tax rate, is equal to 40%. 40% is 0.40. The composite contribution margin ratio, we've computed it to be equal to 0.54. Then you slot everything into the formula. Sales revenue, which is X, is equal to 11,016,000 plus the targeted profit after tax of 0.12 of X divided by 1 minus tax. 1 minus tax, 1 minus tax rate is 40%, 1 minus 0.4. Then everything divided by composite contribution margin ratio of 0.54. Okay. So in this case, X will then be equal to 11,016,000 plus 0.12 divided by 0.6 will give us 0.20 of x. Then everything divided by 0.54. At this point, all you need to do is to cross multiply. The 550.54 will go to x. Therefore, 0.54x is equal to 11,016,000 plus 0.20x. You then collect like terms. Okay? So 0.54x minus 0.20x will be equal to 11,016,000. Therefore, this will be 0.34x equal to 11,016,000. Then x will then be equal to 11,016,000 divided by 0.34. So what do you have there? That's 11,016,000. 11,016,000.
32.
Okay.
32
Divided by
400.
0.34. That's 32,400,000.
Okay.
32,400,000. That is the answer. So the sales revenue to earn a rate of return of 12% after tax is 32,400,000. If you like, you can share this one into two. One for A, the part of it for B. So to share this, 32,400 multiplied by the sales mix of A, which is 20%. 32,400 multiplied by sales mix of 80%. So 32,400 multiplied by 0.2. That's 6,480,000.
480,000.
480,000. Then for B, 32,400 multiplied by 0.8. That's 25,920. 25,920,000. Okay. So when you add it up, of course, still the same thing as 32,400. That is for that. 5 marks. This should be more than 5 marks. That's not fair on the part of the examiner. Yes, the last one, the last requirement, you have to assume all the facts in B1 to 4, B1 to 5 above, with the original budgeted revenue of 33,600,000. Compute the revised break-even sales in units for each of the products. I don't need to waste time on this. Examiner wants you to calculate break-even points in units for each product. You can, by taking into consideration all the revisions that you have made. So number C, calculating break-even points in units. 4 marks. I don't need to waste time. So the first thing you need to do is to just follow those procedures, the 5 procedures. The first thing you need to do is to calculate overall contribution margin ratio. We've already done that, which is composite. So we have composite contribution margin ratio to be 0.54. 0.54. The next step says you should calculate break-even points in Naira for the company as a whole. In this case, of course, you know your break-even point in Naira is fixed cost divided by, this will now be composite contribution margin ratio. Our revised fixed cost is 11,016,000. The composite contribution margin ratio is 0.54. So what do you have there? 11,016,000 divided by 0.54. That's 20,400,000. That's the overall break-even points in Naira. The next step is to calculate sales mix. Already the sales mix is given for A and B. Examiner has told you that 80% is for B. Then 20% is for A. Finally, you then calculate break-even points in Naira and units. Products, sales mix, break-even points in Naira, selling price, break-even points in units. A, B, 0.20, 0.80. We want to share 20,400,000. Selling price of A is 120. Selling price of B is now 160. Okay. Here is one. All right. So point two, 20,400,000 multiplied by 0.2. That's 4,080,000. Divided by 120. Divided by 120 Naira. That's 34,000 units. Okay. Then for product B, 20,400,000 multiplied by 0.8.
16,320,000.
16,320,000 divided by selling price of 160.
102,000.
102,000. That's it. That's the end of the question. But if you don't know, you don't know. Yes, that's the end of the question. Let me know if you have any question for me so that I will stop sharing this. We'll move to a brand new topic, which is working capital management. If no further question, I'll stop sharing this.
I have a question, sir.
Yes, talk to me.
Why do we treat? Sorry, I'm just to get this. You know that the C said assume that the facts in B are above, but with the revenue of this, so it's a compute the break-even sales. So what we actually did here was just the normal thing we're doing with product mix.
Yes.
We just use the information in B above to sort it out, right? So
yes.
There's no particular regards to this 33,600.
We don't need this now. You can use it you are still going to get the same thing, but I don't. In my own case, I don't need it. In ICAN, I can use the 3,600, the 33,600, which is of course what we have originally. When you add up the sales value of the two products, it will give you 33,600, 33,600 million. So I don't need it to get what I need to. What I need to do is to just follow the normal procedure. All right. But in any case, yes, that is for that. Let's move on. Any other question, please?
So just to move it to the last part, let me just see it. Last part of it. Okay then. Thank you, sir. 120,
All right.
60, 20, 100.
Should I stop sharing?
Yes, you can go ahead, sir.
Moses, are you still in the office? So I want to stop sharing this and I'll stop recording as well.